The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp, brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, and that rockin' theme means it's time once again for Options Bootcamp, the show where we break down you raw options recruits and rebuild you into seasoned options veterans. My name is Mark Longo from the OptionsInsider.com, as well as the old Options Insider Radio Network. And I am joined today on the old drill grounds, the old proving grounds, by my fellow drill instructors, starting off with the man from Market Taker Mentoring, good old Dan Passarelli. Dan, welcome back to the show, sir.
It is always a pleasure, Corporal. Do you have a formal military
I don't have a formal rank.
I don't know.
Master Sergeant, I don't know, Master Chief. I could take 5-star General, too. That's always a good one. I don't know if he really would be a drill instructor, but I could step down to that for the purposes of this show.
Cameo appearance as a drill instructor. All right, the General. Mark
There
Longo.
we go. And I am also joined by the man from the server room, a.k.a. John Critchley, the options major domo over there at Sogo Trade. John, welcome back to the show, to you as well.
Yeah, thanks for having me back. I'm just waiting with bated breath for the big earnings announcement in Apple tomorrow.
Yes.
I'm sure we all just can't wait for that. It's just every 3 months. Wow, what an event.
You know, John, let me ask you this before we get started. You know, you work with a lot of different brokerage firms, and it seems like they all tell me that they're just such a significant percentage of their volume on any given day is Apple, particularly coming into earnings time when that number seems to double or even triple. So off the top of your head right now, what percentage would you say of the calls coming into Sogo are Apple related?
I would say probably 20 to 30%. And when I look at the daily trade count, a very high percentage or abnormally high percentage would be spiders and some Google, some Apple. It's just, it's way out of whack. It's by far the most popular option. There's no one even close.
You know, it's funny. I got some flack a while back for referring to Apple in a joking, but only really half-joking fashion as essentially an index unto itself. And when I hear stats like that, that really tends to prove that to me, that Apple really is just this crazy beast that really has just spun off this cottage industry unto itself of trading volume and interest and analysis and expertise. It's just really, really a crazy, crazy development over there.
Yeah. What made this week even crazier is that they had the iPad announcement, or the iPad mini announcement yesterday. So we even have more activity with that announcement also.
Yeah, we can devote a whole show just to options trading around Apple. Maybe we'll do that. Maybe we'll have the Apple block or the Apple perhaps not the Apple block, but the Apple pit. How about that? We'll talk about
the Apple pit. I love it.
All Apple all day long. But yeah, interesting stuff with the Mini. We can probably do a whole show on that as well, John. But I think it's time to dive right into our basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Call in. Prepare to learn. Yes, sir.
All right, and welcome to Basic Training. This is, of course, where we dive into the meat of the show, the heart of the show, if you will, where we really start to try to introduce you to some basic options, concepts, and some strategies and educational elements. And we've been doing that for a while now on this show and introducing you to a lot of different basic options elements. And last show, we did something a little bit different. We busted options myths, and that was a pretty popular segment. So we thought we'd do something along that same line today, where we're going to take a little bit different tack on that. We're going to look at some of the most common, most frequent options trading mistakes that we see. And these are predominantly done by newcomers to the options market, but that's not always the case. We see a lot of people who probably should know better making a lot of these mistakes as well. So this should be an interesting basic training segment. And I'm going to kick it off here with a mistake, and I use mistake loosely because there are some reasons why you might want to do this as well, but I call it a mistake because it really isn't taking advantage of a lot of those core concepts we've talked about on this show many times in the past, like the Greeks. And this first mistake I'm going to kick off our basic training with today is writing long-term options for income. Now, what do I mean by that? I mean what we see with a lot of new options traders, particularly ones who start to learn the product, learn the markets. They listen to shows like this, and they start learning about things like covered calls. So they typically graduate from buying options to writing options for income like covered calls. And so a lot of them will look at the options chain, and what they'll see is the very near-term options are trading for an approximate price point. It could be high, it could be low, but some approximate level. And then they'll start glancing farther out, 3 months, 6 months, a year, 2 years, and they'll say, wow, these options are really trading for so much more than those near-term options. Why wouldn't I write those? And so what they end up doing is they write a LEAP, which is a long-term equity anticipation security, or perhaps an 6 month or more, or 6 month or longer option. And they do that, and they wrap it up in a nice little bow, and they put it away for 6 months or a year or 2 years, and they collect a decent amount of income. But there are a number of problems with that, not the least of which is that it fails to really maximize the Greeks, in particular, one of the Greeks we talked about a lot on this show, theta. Of course, as we've said in our earlier episodes, when you're writing options, theta is your friend, and you want to maximize theta in order to maximize the income level that you're generating through your income strategies. And by focusing the bulk of your writes on the longer-term options, you're neglecting a very key characteristic of theta, which is the bulk of the theta in an option's life. Let's say you have a 3-month option and you're looking at it. It decays a little bit every day as you get closer to expiration. But the real bulk of that decay occurs somewhere in the final 2 weeks of that option's lifespan. And what you typically see is that decay graph going from a relatively linear progression all the way to a near exponential curve towards the last few weeks of that option's lifespan. That's where you have a significant percentage of that option's decay occurring. So if you're looking to maximize your theta, looking to maximize the income you want to generate from writing options, and you really should be focusing the bulk of your liquidity on that exponential portion of the curve. And so instead of writing these, let's say a LEAP or a 6-month option, you could write a 1-month option. And for some of you you could even start looking at the weeklies. I wouldn't jump into that right away. But what we've seen is that and there's a lot of data backing this up, and maybe Dan and John, you might have some of this as well. But there's a lot of data, which I really can't get into here right now on the show. I wish I could. But looking at if you, instead of writing that one LEAP and putting it away, you write that same approximate level of LEAP, that same approximate out of the money or in the money call every month for 12 months versus writing one option for a year, you typically will dramatically outperform that single long-term option, both from a total return and a risk-adjusted perspective. It's just a much, much better style of trading for income. And that same analysis has been done recently and been applied to the weeklies as well, where people looked at writing a one-year option versus monthly versus weekly and the amount of raw premium that is generated through each of those strategies. And not surprisingly, the weeklies, because they essentially live in that exponential part of the decay curve, they really generate a lot of raw premium from a premium perspective. Of course, there's a downside to that frequent level of trading, which is you're going to have higher commissions. You're going to have a lot more time spent trading once a month or 4 times a month versus once a year. So if you're very time constrained, like a lot of busy financial advisors or asset managers, you're typically may want to look at the farther end of the curve just to save yourself some of the hassle, even though you know it's not maximizing your trading. But if you're really looking to generate income and maximize the amount of income that you want to generate by writing things like covered calls, then you need to start focusing the bulk of your liquidity on the shorter term, 1 month or even shorter versus 3 months, 6 months, or even 1 year or 2 years out. Now, Dan and John, do you guys encounter this a lot with your students or your clients over there at Sogo Trade?
Yeah, I just wanted to add to some of your comments, Mark. We do encounter it, and let me first say that we all know what a wonderful strategy covered calls are for the retail customer. They're a wonderful invention and great strategy. But you're absolutely right. The weekly options now, if you do covered calls, have turned out to be more profitable than the monthly and certainly the leaps. But as you said, there are two issues to keep in mind. One is the commissions. You're selling calls 4 times a month versus once a month, and the commission cost will generally eat away at a portion of the return. But at a company like or a firm like Sogo Trade, we have a very low commission structure. So if you want to do that strategy, a place like Sogo Trade would be great for you because of our low rates. And the second thing, and you mentioned also, is that you're going to have increased time for portfolio management. So make sure you're willing to dedicate that time to monitor it on a daily, week or certainly weekly basis versus selling a 3-month call or even 1 month and, watching it maybe once a day or every so often. But a weekly had to be much more proactive. So keep that in mind also.
And John, you have that 100 free trade offer going for listeners of this show. So if you're looking to test out this strategy, perhaps in the weeklies, and you're concerned about commissions, that might be a good entry point for you to take advantage of that offer and try your hand at this for a while and see if it works for you. And of course, you won't have the 4x commission increase you would have with some other brokers because you're going to have 100 free trades. And Dan, what about you? Do you encounter this with a lot of your clients and mentees over there at Market Taker?
Yeah, the people who are pretty new entrants into the option trading arena, I spend a lot of time explaining just what you said to them. If you sell 12 consecutive 1 months, it's usually better than selling 1 12-month. Or if you do 4 weeklies, it's better than selling one month. But, every once in a while, once people kind of grasp that concept, here's one of the traps that I sometimes see people fall into, is they don't think about prices. And weeklies can be awesome to sell options on, but they're not always, because sometimes the proximity of the strike price to the current stock price, just kind of doesn't match up how you want it to. Like sometimes the nearest out of the money call, if you're looking to do like a call credit spread, sometimes that nearest out of the money call is too far away from the money. And if you sell it, you end up selling a $5 credit spread for a nickel or something, that's just the one thing that I want people to be aware of. Yeah. Always look to sell those weeklies first because that's your highest theta, but you better look at the price you're selling it, because a lot of times people kind of omit that really important step.
That's true. Once they start getting lured to the dark side of premium selling, they tend to neglect the actual value, the actual reward they're getting for the risk they're taking. Sometimes they take on risk that is not exactly commensurate to the reward that they're collecting over there. Well, that's my kicking things off with my long-term versus short-term option writing discussion. John, why don't you take it next here and walk us through one of your most frequent options mistakes that you witness with the customers and clients over there at Sogo.
This may be our biggest mistake that our new customers make, is using market orders in illiquid options. The best tactic to use for a new option trader is to trade limit orders, if you can. If you are attempting to put a position on as quickly as possible, what we advise our clients to do is simply put a limit buy order, for example, at the ask price, or a limit sell order at the bid price. This way, you will get filled at what effectively is the market price, but you won't allow for any bad prices or fills by the market makers. If you want to rush to get filled, simply put a limit order. If you're in no rush to get filled, simply put a limit order at the mid price. This is the halfway point between the bid-ask spread. There are going to be times where you might want to put a market order. Apple, spiders, very liquid underlyings. But if the option is illiquid, try to use a limit order at the bid-ask average. And the majority of the time, you'll find that you probably will get a fill. And you know what? Guess what? If you don't get a fill right away and you get a little antsy, then you can maybe take the offer if you want to buy, or you can hit the bid if you want to sell. But try to use limit orders if you can, and try to avoid market orders. Not at all times, but especially in the illiquid names out there.
Yeah, definitely good advice, I think, for a lot of our listeners. They come from the world of equities predominantly. They're used to, in a lot of cases, just working market orders in a very liquid equity name, and they might lose a few cents here or there, but usually they're not run over, and they go to an illiquid name like in the options market, and all of a sudden it's a very, very different ball game indeed. So something very important to keep in mind there.
Yeah, can I just mention one more thing about this issue, because it's very dear to my heart?
Sure.
Let's say, let me give you a simple example. Let's say an option, the price in the marketplace is $2 bid at $2.50, and the option is illiquid. Well, if you pay $2.50, or if you sell it at $2, you're in essence giving up 10%. What do I mean by that? Well, the fair value, the rule of thumb, is going to be, of course, the bid-ask average of $2.25. And if you pay $2.50, or if you sell it at $2, you're giving up, right off the bat, you're giving up about 10%. So if you bid, let's say $2.30, or you bid $2.35, or even $2.25, you may get filled. And I also want to mention, I'm sure Dan can touch on this, and Mark also, when you do spreads, multi-leg spreads, there's even more reason to put a limit in there, because now you have at least two sides that you might be taking the offer, hitting the bid, and then all of a sudden you're really giving them a lot of edge or a lot of vig in doing the trade.
Oh God, if you go in with a market order on a spread, then you're really just asking to be taken to the cleaners, particularly in a very illiquid name.
Oh yeah, I've got a 4-part class that I have recorded on this. It's all on execution techniques, and I talk about this exact thing. People middling markets, on illiquid stocks, or more specifically, options on liquid stocks. You can middle the markets, and a lot of times you get filled. Sometimes if it's just totally thin, the market makers don't even want to buy their own bid or sell their own offer, and they won't let you middle it. But with spreads, geez, man, they'll almost always let you middle it, because it's more reward and it's less risk for a market maker when they trade a spread. When a market maker buys a call, he's just going to go in there and try and sell some other call anyway. He's trying to leg into the spread and do the best he can to do that as fast as possible. You give a market maker the opportunity to trade a spread, and he'll cut his own profit a lot of the time,
I think that's probably a good subject for an entire episode down the road, perhaps, is spread execution and the myriad issues and problems that people encounter when they first attempt to do even a simple vertical, let alone a calendar and other things, and they see that a spread is bid or offered on their brokerage screen, but they don't realize that it's actually one option's at one exchange, one is at the other. Why am I not filled? I'm lifting the offer. I think that might be, given the frequency of questions we get on that exact topic, that might be a great topic for an entire episode down the road. So I'll keep that in mind, because spread execution certainly is very much still a dark art in this day and age, and it's an unfortunate thing, but it's true. So Dan, now that you are prepped and ready, sir, what mistake would you like to illuminate for our listeners?
Here's one that I talk about all the time with my students, especially income traders. Closing options when they're offered at a nickel. And a nickel isn't the exact cutoff point, but it's for sake of having a discussion point. Let's just call it not closing options offered at a nickel. When you put on an income trade, like you sell a credit spread, or you put on an iron condor or something like that, which is 2 credit spreads, the premium you take in initially, of course, is your maximum profit. And you can lose the difference between the strike prices minus that initial premium. But as each day passes, and if the trade's working out and your spread gets worth less, which you want it to, at some point, whatever the spread is worth is your maximum profit from that point forward. So once you get to the point where your spread is offered at a nickel or a dime, maybe you sold it for $1 3 weeks ago, and now it's offered at a dime, say, the most you can make from that point forward is a dime. But you can lose all the profits you made and a whole bunch more if the market goes against you. So, traders need to always look at their spreads that they have on from a risk-reward standpoint. How much am I really risking here from the reward from this point forward? So, great rule of thumb, close everything before expiration, because at some point the risk-reward is just not worth it anymore.
Yeah, when I was on the floor, we always used to close things out, even in the SPX, things that were, many, many strikes away. We'd close them out. I used to annoy the brokers all the time. Hey, can I buy back 16 of these or something crazy? And they'd be like, why are you bothering me with this? But hey, I want to close out all my strikes, because at the end of the day, it's not worth having that risk on. And I'm glad you mentioned that, Dan, because I bring that up in my talks on these a lot as well, is just not that exact premise of trying to eke out every last little cent of it. Sometimes it's just laziness. You don't want to close it. Sometimes they're being cheap and they don't want to pay that extra commission for such a cheap trade, or sometimes they just don't understand the true risk they have on. Either way, if you get down, I think a nickel is a good rule of thumb. Some people say below a dime, but whatever the case may be, that really depends on where you sold it from. But a nickel is a good rule of thumb. That's also a good rule of thumb because that's where a lot of brokers typically will give you a break if you're looking to close those things out. John, what is Sogo's rule on closing out shorts that are, let's say, a dime or a nickel below? Do you guys offer any sort of commission incentive to do that?
Well, we don't, Mark, but what I like to tell our customers or the guys I work with when customers call in, because, of course, starting about Wednesday or Thursday, we start monitoring Friday's expiration, and we see a lot of these, low price options, and we will send an email to our customers saying, please be aware these options are low price and you can close them. And I want to mention one thing. As Mark and Dan, as fellow traders, we all know the stories about don't be a pig, pig gets slaughtered. The rule of thumb that we like to tell our customers is that if you can keep about 80% of where you sold something, in other words, you sold it for $1, now it's trading maybe 20 cents, you should probably buy it back. I mean, if you don't, one of these days, that short option is really going to bite you back, and you're really going to get hurt. I remember one time I was trading an Amgen, and it was 59 at 4 o'clock on a Friday expiration, and the news came out about 4:30, and it went to 70. Now, guess what happened to all the people that were short to 60s and 65s and didn't buy them back? They lost a lot of money. So we try to counsel our clients, if you can, please try to buy these options back so we don't have any mistakes after 4 o'clock on Friday. Now, also, we also know, and Mark and Dan, also that these days most companies are very, very aware of expiration Friday. So there usually is almost a news blackout after 4 o'clock on Friday. But you know what? You can still have macro events. You can still have maybe FDA rulings, maybe a court ruling. So the companies might be aware of this, but you can't control the whole news cycle. So if you get a chance, just buy the option back. Again, you sold it for $1, trading at 10 cents, and Dan is 100% right. Would you sell that option for 10 cents? No, you wouldn't. So if you wouldn't sell it there, just buy it right back.
Yeah, someone came up to me after a recent talk I gave on this topic and asked me that exact question. What is your rule of thumb? What is the rule of thumb for buying an option back when you want to close it out? And there really is no hard and fast rule. Obviously, it depends where you sell it. It depends on volatility levels and things like that. But I think in general, once you start getting south of a dime, that's when you start thinking of that. And definitely south of a nickel, that's a good rule of thumb. If you need one from a premium level, from a price level, which price level should I think about closing it out? I think a nickel is a perfect way, because that's where that's just a good rule of thumb to have in the back of your head. If you're getting down to a nickel, pigs get fed, hogs get slaughtered. Don't be a hog. Close it out. And now I'm going to actually talk about the flip side of what Dan was just talking about. He's talking about writing a lot of options, out of money options and what have you, and letting them decay to nearly zero and being a pig and not closing them out and then having the risk come back to bite you. Well, the flip side of that, and another mistake we see with a lot of beginning retail options traders, is they come to the options market, they learn about things like we talked about on the earlier episodes of this show, leverage and what have you, and they say, wow, I want to experience that for myself. So I'm going to go in And perhaps instead of trading Microsoft stock, I will trade a call option on Microsoft. So they'll look up and they'll look at the at-the-money options on Microsoft, or perhaps maybe a better example is Apple. Apple's probably a great example. And they'll say, wow, these are really too expensive for me. So I'm going to migrate my trading, my liquidity out to some of these farther out of the money strikes. And they'll start looking at, some of these options that are getting pretty far away from the out of the money, or from the at the money, pretty far out of the money strikes. And they'll say, wow, I can maybe afford to buy one at the money of these, but I can buy 10 of these out of the money. So that's what I'm going to do. I'm going to load up on these 15, 20 delta options and buy 10 or 20 of them, because that's a much better trade for me. And then it goes my way and I'm going to be a millionaire. And what happens with that, if you pay attention to any of our earlier shows, we talked about the Greeks, in particular delta. Delta has many, many meanings, including the probability of that option expiring in the money. And so you should be able to just intuit very quickly that with an at-the-money option having a delta of approximately 50, and as you start getting out of the money, that delta gets south of 50, and it gets south of 50 pretty quick. So if you're migrating the bulk of your liquidity in these options that are 25, 20, 15 delta, you're really putting a lot of your eggs in a very, very low probability trade, substantially lower probability than even a coin flip. And so that doesn't really take a genius to realize, wow, that's not exactly a recipe for long-term success. Never mind some of the other characteristics we've talked about, like theta. Remember, when you're buying options, theta is not your friend, it is your enemy. And we talked about extrinsic and intrinsic value on the show. When you're buying out of the money options, you're buying nothing but extrinsic value. There is no meat on those bones. There is no intrinsic value. So essentially, you're buying options that could literally decay to nothing, and they typically do in most scenarios. So that's a very frequent mistake, is migrating your liquidity up to these cheaper out-of-the-money options. Remember, you get what you pay for. They're cheaper for a reason. And so what I typically counsel the people is, if they're looking at this and they're having issues and they're very premium conscious, one way to get around that and get a better payout profiles is do something simple as a simple vertical call spread, where instead of buying the at-the-money option or instead of buying a ton of out-of-the-money options, you buy that at-the-money or maybe near at-the-money option, and then you write a farther out-of-the-money option. And what that does, that allows you to migrate your liquidity closer to the at-the-money strike, so you get much more of that bang for your buck. You get more of the Greeks, you get more vol, you get more delta, a much meatier option. And then it still reduces your overall premium risk, because you're writing that out-of-the-money call against it and taking some of that money off the table. So if you're one of these people who's looking to do this and load up on these out-of-the-money options and just swing for the fences, save your money, look at some other ways to do it. Listen to our earlier episodes of this show, and they will provide you with, I think, some better options, pun intended, for places to place your trades. All right, John, I turn it over to you again, sir. What is one of your other mistakes that is eating you up inside, and you'd really want to share it with our listeners and dispel it for them?
Well, one of the things I like to talk about is just using, going to the option chain and using the pure implied volatility calculations that Sloco Trade lists and most platform lists, and using that as a sole guidepost to whether you buy or sell an option. And what I mean by that is that I receive this question all the time. How do I determine whether implied volatility is high or low, and what is the basis for this comparison? Well, the answer is that implied volatility, or whether or not it's high, is completely subjective. But you must make a comparison between the current implied volatility you're looking at and historical range of either implied volatility, historical implied volatility, or the historical real volatility of the underlying. And if you do that, then you can get a better gauge on whether or not it's a good trade. You just can't look at that pure implied volatility number. And I think one topic that we can touch on also is that with the weekly options now, this is why this issue is so important. With the weekly options now, on Thursday night or Thursday afternoon or Friday even, if you look at the expiring options in a Google or an Apple or a Priceline, the implied volatility numbers may be very distorted. And they give you a very bad view of, wow, I'm selling 110 volatility in Google or Apple. Well, you know what? You're really selling a 30-cent option or 80-cent option, and the implied volatility number gets very distorted. So please be careful when you use the pure implied volatility number as a guidepost to whether or not buy or sell. Use a more comparative method.
Dan, you're Mr. Greeks. That's what I'm going to call you for the rest of the show, Mr. Greeks. So what do you tell your mentees when they're looking at things like implied vol on names that are a couple of days away from expiration. They're really just trading gamma rather than vol. What do you tell them in those scenarios?
Yeah, it's funny when I'm talking to especially newer option traders. I beat them over the head so much saying, oh man, you got to look at implied volatility. You got to look at it. It's so important. You got to look at implied volatility. And then, we start talking about weeklies or something. I say, forget about implied volatility. It doesn't matter. They say, wait a minute, what are you talking about?
Yeah, it probably is a bit of a head scratcher for them at first because you've been beating them over the head with vol for so long. Then you get into the weeklies and it's a moot discussion.
Yeah, that and, on top of that, of course, when you have really far in the money options or out of the money options, where it looks like the implied volatility is like 500 or something, but really it's not. It's just because the bid ask is so comparatively wide compared to the Vega, So, it's not enough just to know the definitions of the Greeks and know how implied volatility works, but, you kind of got to get under the hood and get into some of the minutia of it. And to be able to use it effectively, you got to know all these little quirks.
There's a lot to get into on the vol topic. Maybe we'll get into some of it. We have a listener question later, if we have some time to get to those, that delves into the implied vol a little bit more. So maybe we'll get into it a little bit there. But Dan, what's next on your list of mistakes or trading errors that are just clawing at you and you're dying to get out there?
Well, you know what? It's kind of in the same vein of, hey, make sure you do this, but, don't always do it. And that is adjusting. I know that I spend a lot of time in my presentations telling people how to set up a trade, but truth be told, what determines whether you make or lose money is how you get out of the trade. And when trades go against you, you sometimes have to be kind of creative in order to be able to skirt losing money. And what I teach and what a lot of experienced traders teach and do is adjusting positions, especially income trades. Adjusting simply means you change the physiology of a trade from one, set of options to something different. So maybe it's the November 50-60 call spread, and you change it to the November 55-65 call spread. Now, adjusting can save your behind in a lot of scenarios. But here's the thing with adjusting income trades. The one thing that characterizes income trades is negative gamma. Now, what negative gamma means is that when the stock moves, especially if it moves a lot, it creates adverse deltas for you. It means when the stock goes up, you get negative deltas, bad, you're short while the market's rising. And when the stock goes down, you get long deltas, which is bad because you're long as the market's falling. When you adjust, you take your delta and you bring it closer to zero. That's what most adjustments are. They're basically delta reduction plays. So when you get short deltas because the market rises and you effectively lose money on those short deltas, when you do an adjustment that gets you long deltas, you're effectively buying those deltas back at a higher level. So basically, it's the exact opposite of what you're supposed to do. You're selling low and buying high. So people really need to beware of what I call over-adjusting, or what I refer to in one of my recent webinars as being an adjustaholic. Every time you adjust, you're locking in a delta loss. Now, that doesn't mean you should never adjust, because the adjustments are designed to give you a better trade that has a better fighting chance of turning around and making back those losses that you would lock in with an adjustment. But, if you adjust every day, you're just, you're doing something dreadfully wrong.
That gets into a very touchy subject for a lot of people. I remember when I was on the floor, I'm sure you saw this too, Dan and John, of guys who were just hardcore premium sellers, and the term adjustment was just anathema to them. They would never take their lumps, and they would let their gamma run how many strikes away from them before they adjusted. So there certainly is a discipline involved in being willing to pull that trigger and being able to take your lumps and adjust on a negative gamma position like that, because that's where the rubber really meets the road. But on the flip side of that, you're right. You can really go down the rabbit hole and start over adjusting, and then you're just doing damage for no reason. that might be another good topic for a show down the road, too. I'm getting filled with ideas as we're doing this show about trade adjustments, because you're right, Dan. Everyone talks about trading and picking your right trades and setups and which trades to buy, which options to sell, and vice versa. But 99% of the time, the real meat of that trade is in what you do after you put it on. And that might be something down the road. Obviously, it's a little bit more of an advanced topic for our audience, but maybe in some future episodes when our audience is ready for that, we can get into that subject matter in a little bit more detail. And John, I know you have a bunch more you really want to get to. I know you're just champing at the bit over there. So why don't we do one more of your really, really pressing mistakes, and then we'll dive into our mail call segment.
Yeah, this is the one I think we touched on maybe last week, but I just want to go over it again because it's a big mistake that I think a lot of customers that, especially that from the equity side, that come over to the options, and it's the belief that sell stops are better than wasting money or wasting premium on buying downside puts for protection. It's a mistake of not realizing the idea of gap protection and the believing that sell stops, fully protect you. What does this really mean? Well, number one, again, puts offer gap protection. If Apple is 610 and earnings are coming out, you want to protect your gains and limit your downside 10% before earnings. There's two different ways, or many different ways. What's two different ways to protect yourself would be enter a sell stop equity at 550, or you could buy the October 550 puts for $1. Now, again, we went over this last week, but what happens if Apple has bad earnings and the stock opens at 520? Well, your stop will go off, and your market order, equity market order, will get for the 520. Meanwhile, the puts that you bought basically allow you to sell the stock Apple at 549, 550 minus $1. So, again, I will, for a disclaimer, say there is a flip side. Apple goes higher, and you do lose that premium that you paid, the $1. But I just want to, again, reiterate that there's really no right answer. But by buying puts, you're not wasting premium. Again, most downside moves, large downside moves, okay, happened pre-market. And I say this in the face of what happened with the Google pre-release of the earnings. This is a very, very rare example, and made big news that they released them early and the stock went down to 680 intraday. It was a big boo-boo by the company, but that was a mistake. You'll see very rarely. Most big moves are going to happen, pre-market. So just be careful thinking that sell stops, if you're an equity guy and you're doing options, are going to fully protect you. Puts might be a better way. Cheap puts for $1 or $2 may be the better way to go.
That dovetails very nicely into one of our listener questions here we have on the show. So I think perhaps with that, we will close out our basic training segment and dive right into our mail call segment.
Mail call. Time to look at questions submitted by our listeners.
All right, and welcome to the mail call. This is, of course, where you, the listener, get your chance to chime in and sound off, if you will, here on the old Bootcamp show. And our first email comes to us from John S. And ironically, John, this is what you were just talking about, so maybe we'll just dive into this again really quick to answer it here from good old Mr. S. And he writes, which is the better method of portfolio protection, a put option or a stop order? Well, that is exactly what, John, what you were just talking about. And, it really comes down, like you said, there is really no right answer. There are different strokes to different folks. But at the end of the day, you're paying for options. You're right. So you're paying for that protection. And that is certainly something to keep in mind when you're putting on that trade. But the reason you're paying for that is because options offer so much more in the way of protection than just a simple stop order, because you're right, you have that gap risk, and that is something that an option is going to protect you from. If you buy that option on that strike, if you gap below that strike, you're protected. And so that is really one of the primary reasons that people shell out the money for that quote-unquote insurance, for that premium on that option, because they realize that just a simple stop order by itself isn't going to get the job done, because look at that example in Google that John just laid out for us, how the option, or I'm sorry, how the stock gapped down off that news. And if you had a strike or a stop order somewhere in the middle of that range, guess what? You're not getting filled in the middle of that range. You're getting at wherever that first move settles out. And usually that's many, many, many handles below where you wanted to get out of that stock. So stop orders, people tend to put a lot of their faith in them. And in reality, in many of the scenarios where you would be reliant upon a stop order to save you, stop order, not exactly a very helpful thing in a lot of those scenarios. So if you're in a very volatile name, if you're in a name that you're worried about a lot of gap risk, or if you're just in general worried about gap risk as a whole, then definitely it is worth investigating using put options as opposed to stop orders. And of course, if you're very premium conscious, as everyone is, there are ways to mitigate that premium outlay from you don't have to go out and just buy the puts by itself. You can perhaps look into put spreads or put ratio spreads or collars. Everyone loves collars these days. So there's a lot of different ways that you can set up a put in a more favorable way that is still, all those things I just laid out are for the most part improvements over a simple stop order. John, I know you agree with that. Dan, do you agree with that as well?
Yeah, there's never one strategy that's one size fits all. And stop orders existed before listed options, if I'm not mistaken, and puts came along and didn't totally replace them. They just do something different that sometimes is more advantageous and maybe sometimes isn't. So, it's kind of all part of the trader strategy,
Yeah, I guess if you just if you're just day trading in and out and you want to get out at some price near where the thing is trading right now, you just want to get out pretty easy, that's a more advantageous moment for a stop order versus putting on a put and letting it ride. But, there are many scenarios where if you're really looking to protect a significant portfolio for a significant period of time, an option is certainly preferable to a stop order.
Can I mention one more thing about the stop orders?
Never.
Never. Stop orders, they're also vulnerable to bad ticks. Now, on our platform, we have what we call triple touch. So one bad price on a bad print won't elect the stop order. We have a triple touch, and we have other volume and price percentage, safeguards. But even with that, every so often we'll get a bad tick, and some stops will go off. And a lot of times we can't break the trade. So that's another thing, that if you use a stop order, you are vulnerable to the occasional bad tick or bad price of the underlying.
Yeah, so there are just many reasons, many of which we just laid out, that you would prefer putting on a put option versus a stop order. But not all scenarios, but in many scenarios, when you're looking for that real protection, the option is definitely the better choice of the two, and not because all of us here on the show are diehard options vets. It's just the truth. We're not biased at all. But next we have an email from Phil K. I wonder if he's related to Philip K. Dick. Probably not. And he writes in, I'm very interested in weekly options. And this is another theme of our show today. He's suggesting a topic for us as well. He goes on to say, they appear to be very popular products right now. And yes, Phil, they are. He goes on to say, can you do a show about weekly options for those of us who are thinking about diving into these products? Perhaps common mistakes, misconceptions, myths, errors, etc. Thanks a million. I just discovered this show and I've already learned a ton. Tell John I'm on the Sogo Trade site right now and I'm about to pull the trigger. So there you go, John. A happy listener right there. I'm assuming he's pulled the trigger already by now, but I don't know.
Yeah, we love to hear that. Weekly options, I love weekly options, and they comprise an ever-growing percentage of our business and other brokerage or platforms business. They are very, very popular with active traders and customers who like to play, the events or the earnings. Back in the day, I used to trade Apple, and the earnings were always the Thursday before January, April, July, October earnings, so everything was okay. We had a lot of activity, but then one year, the earnings slid to the week past expiration, and then that depressed volume activity. The weeklies have solved this problem. It's great for customers, great for market makers. The one thing customers need to understand, or one of the mistakes they make, is, and I think Dan is the real expert in this, the Greeks, is the decay. People will come to me and they'll buy an option weekly for $1.50, and then a day or two it's like 30 cents or 40 cents. I'm like, oh my God, what happened? I think the issue of decay is one of the areas that the customers don't always fully understand or grasp.
Dan, what do you have to say about that, sir?
Yeah, that kind of stuff's important. I mean, it kind of goes back to what I said before, just about it's not enough just to know what the definitions of the Greeks are and have a somewhat of a rough idea what they do. You really kind of have to fully understand them and see how they harmonize together and learn all their little quirks and tricks and that kind of thing, because the idea of what John was just talking about, or what we're talking about here, this nonlinear rate of time decay where the short options decay at a faster rate, if you understand that, you can be a better trader. You can be a more successful trader than most of the chumps out there who don't have that information. So, it's really, really helpful for you to understand the product that you're trading. The more you understand it, the better. And, that just comes down to my usual mantra of education. That's why it's so important.
Well, thank you for your email, Philip K. Dick. That's what I'm just going to call you from now on. And
can I add one thing about the weekly options?
Sure.
This kind of dovetails back into the implied volatility discussion. I'll make it quick. When you're looking at implied volatility for weekly options, they're almost irrelevant, especially as they get towards Thursday or Friday. I mean, example is Amazon's having earnings tomorrow night, and the stock's around 230. I think the straddle's like $20. And the implied volatility, if you look on it, is like 100. Well, the November options 230 line is about 47. So a mistake a customer may make is say, well, I'm going to buy the November at 47, 48 volatility, November 230s, and I'm not going to buy the weeklies. Well, that might not be the best trade. And, we can, down the road, we can go into that more on a future episode. But again, when you look at weeklies, I tell the customers, look at really the premium or the extrinsic value, the premium over parity. That's the real number to look at. Do not always look at the implied volatility numbers. Look at that, what they call POP, premium over parity.
Keep the POP in mind. That's a good rule of thumb. And this is an interesting suggestion, Phil K. And I think it's another good topic for a future show. Weeklies are this very weird beast. They were created a few years back as a way to really hedge event risk. They were designed for those scenarios you were talking about, John, where you want to hedge against Apple earnings or things like that, or perhaps speculate on them, and you didn't want to buy a whole month's worth of premium just to do that. What's unfolded as these products have been launched is really the complete opposite. These products have really become premium sellers' dreams, and the vast majority of the volume that is going up in these is on the sale side as opposed to the buying side. So I think that surprised a lot of people. It doesn't really, when you think about it for a little while, it shouldn't be that surprising because these are essentially all extrinsic value products, and they're decaying like mad. They're in that high point of the exponential part of the decay curve that we talked about earlier in the show. But it is interesting to see how these products have unfolded post-launch, and they've done some interesting changes since that launch to try to mitigate some of that and make these products more viable from a buying perspective, and perhaps to do some spreads week 1 versus week 3. And it also changes when you look at futures weekly options versus equity weekly options. So there's a lot of things I think that would be interesting to get into. So perhaps that is a good topic for a future show. So we're just loaded up with future topics here on today's show. So we have a lot to keep in mind for future shows. Next up, we have a tweet from XZav, or I'm not sure. I love these Twitter handles. You never know how to pronounce them. And he writes more of a basic question from some of our earlier shows, but gets into a lot of what we're talking about today. He writes, what do you mean by implied volatility? What is the difference between implied vol and historical vol? Dan, since you're Mr. Greeks, you want to take this one?
Sure. You'll oftentimes hear people make the comparison between options and insurance policies, because that's kind of the fundamental economic purpose for options, to insure stocks or other optionable assets. And what you're really insuring them from is volatility. I mean, people are more apt to buy options for protection when the market is feared to become more volatile. Now, here's kind of where the rubber hits the road. With option pricing, things are very, very specific. There's a few things that affect the value of an option, and this buying and selling, supply and demand pressure for options, rooted in the fact that, rooted in the concept of future volatility, I should say, is one of the really important things. So you can kind of back out of the prices of current options what the market expects future volatility to be, or specifically what future volatility is implied by option prices. So that's where the words implied volatility come from. It's the future volatility expectation implied by current option prices as market participants buy and sell options based on expectations of future volatility.
Yeah, if you listen to our earlier episodes, we talk about the Black-Scholes formula. Obviously, a key variable in that formula is the volatility. Now, of course, if you're pricing an option right now, what you're looking at is the future, what's upcoming volatility. And how do you know that? You don't know that. You have to make your best guess. And that's what we're seeing in these options prices. So if you look at the options prices and you pull out the interest rate and you pull out the premium associated with that and the cost of carry and you pull out the intrinsic value, the little portion you have left over is the volatility premium portion. And that amount can be backed out into the level of volatility that is implied by that options price. So that's essentially what we mean. Just if you look at where the prices of options are trading right now, what level of volatility does that imply for the near future? So that's what you're looking at. And in terms of the difference between implied vol and historical vol, very straightforward. Implied vol is really just the market's best guess of what is coming down the road from a volatility perspective, whereas historical, or it's also sometimes called realized vol, and that is the actual volatility that has occurred in the index or in the equity or whatever the case may be. And I would encourage you, XAV, or any others out there who are really interested in this topic, implied versus realized volatility. We get into this quite a bit on our Volatility Views program here on the Options Insider Radio Network, and I certainly think this is something that would interest you. But in general, realized or historical, that's just what you see on the old charts. That's what the amount of volatility that actually has been exhibited by the product you're looking at versus the implied. That's kind of the market's best guess at what is coming down the pike from a volatility perspective. John, anything to add on the implied versus realized vol tip?
Sure. The one thing I wanted to mention, this is a fun fact for our new traders or our new customers. Implied volatility is, I think the studies were done 80% of the time, the implied volatility is going to be higher than the realized volatility. And that's because it's people are hedging or protecting themselves, but it's forward-looking. What might happen? There's uncertainty. So if you look at the implied volatility, normally it's going to be higher than the real historical volatility. Now, if you see a turn and go the other way, that might be a signal to do something. And maybe in a future show we can get into that. But normally the implied volatility is going to be higher than the realized volatility. And that makes sense, really. I mean, imagine if a stock was moving 10% a day or 5% a day, and you could buy implied volatility that, at 4%, whatever that might equal out to, you would do it all day. And then you would just buy, sell stock, and traders, where they make money forever. So the implied volatility normally is going to be higher, and that does make sense.
Yes, that is known as the volatility risk premium that is priced into a lot of the options we see trading today. It's also a reason why a lot of people who lean towards the dark side of the fence, towards the premium selling side of the fence, that's a reason many of them frequently cite for wanting to sell options versus buying them, because regardless of where you're trading them, you're trading on a volatility level that is typically and can be sometimes substantially higher than the actual vol that is being exhibited in the underlying. So why would you buy that volatility premium when you could sell it? So that's what a lot of people who are on the premium side of the fence, or premium selling side of the fence, I should say, like to cite as their reasoning why. So a great question, Mr. XZAB. Great questions from all of you here on the old mail call segment. Unfortunately, that's all we have time for this week, but I want to thank all of you who wrote in and made this segment so great. We hope to have more questions from you guys coming down the road in future episodes. But before we go, I want to check in with my fellow drill instructors and see what they have coming down the pike that may be interesting to you, the listener. Starting off with you, John, what is coming up in the land of Sogo Trade?
Well, we're in the final stages of beta testing our new application-based option platform that I've been working on. It's called Power Options. This is similar to our web-based, but again, it's application-based, so it's going to be much more stable than the web-based platforms that our other competitors offer. And with our low rates, it's kind of hard to beat it. You also can follow me on the Sogo Trade Options on Twitter. We have plans for a while now to make our internal options blog, which I give to internally to our personnel here to make that public. And we're going to have in about a month or two a Sogo mobile app. Right now we have a dedicated mobile website, which is pretty good for trading on smartphones and tablets, but it's not an app. So we're going to have an app in probably the next maybe 6 to 8 weeks, and that should be really great for our customers.
Oh, that's going to be huge. I know a lot of our readers and a lot of our listeners here at the Options Insider, that's the primary way that they interact with their brokers, through the mobile app. They're on the train, going to work, or whatever the case may be, working out, and they want to place their orders throughout the day. So that certainly will be interesting to see when that app launches. I know a lot of our listeners will be excited about that. And Dan, what is going on in the land of market taker mentoring?
Oh, man, I actually do have something really, really exciting, and I promised myself I wasn't going to say anything until November 1st, but you know what? I'm just an impulsive kind of guy, and I just can't help myself. Our most popular class is our Market Taker Live Advantage group coaching class. And that's a 2-day week class on Tuesday and Thursdays where our head coach goes into the market and you watch him finding trades in the live market. And it's great. You get put into the mind of a trader. You get to learn how somebody who's been in options for 20 years thinks, and you get to watch real time trades being found. You can get 20 trade ideas per show. Instead of doing it twice a week, we're going 5 days a week with it, which is going to be awesome.
Oh, hardcore trading there over at Market Taker Mentoring.
Yes, and the best part, and here's the deal, here's what I'm excited to offer everybody, is that from now until, I don't know, I haven't decided how long I'm going to run this program, but if you're in the program now, you get to stay in at the old rate for as long as you want, because, we're going to be adding 150% more to the product, and we're going to raise the price accordingly. But if you're in now, you're grandfathered in at the old prices. So it's really, really a great opportunity for people who are already in the class and people who sign up in the near future before I raise the price.
There you go, listeners. You heard it here first. If you want to learn more from Dan and his team over at Market Taker Mentoring, the man who wrote the book on the Greeks, then surf on over to markettaker.com. I'm sure you have that link right up there prominently for all of our listeners to find, Dan.
Yeah, it's very easy to remember. It's simply markettaker.com/GC, stands for group coaching.
There you go, listeners. Surf on over to markettaker.com/group coaching and take advantage of that offer before it's gone. And of course, we want to encourage all of you to surf on over to theoptionsinsider.com. You can post questions for us on the show like some of your fellow listeners did today. You can get us via the comment form on the website. Of course, you can reach us via Twitter. We're just at Options on Twitter, or via Facebook. Just search for Options Insider. You can just shoot us an email. questions@theoptionsinsider.com. Just put Options Bootcamp question in the subject line so we know which show you're referring to. So once again, from all of us here on the Options Bootcamp Drill Instructor team, we want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this show and making it such a success. And we'll see you next time right here on Options Bootcamp.
Options Bootcamp is brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.